how to use no money to buy real estate. Rich Dad said, real estate is wealth. Those that control the real estate control the world.
The beauty about real estate is you'll learn to use debt to get rich. I'll give you another tip. If you're going to be rich, you have to learn to use debt. It's called other people's money. So when I hear poor people say to me, I don't have any money, I said, because you're an idiot. That's why. You're not supposed to use your money. You're supposed to use other people's money. But that's debt. I don't want to do that. And so they stay poor.
And making money is really easy.
And you will find that today. The word education, there is no financial education in school. There's 4 types of people in business in the world, anywhere. Spain, US, China, Japan. There are employees. Employees have a mindset. Employees all over the world say the same thing in their head. I want a safe, secure job with a paycheck and benefits and a pension. And this is small entrepreneur, small business, or specialists like a doctor, lawyer, attorney, real estate agent, massage therapist, web designer. S means small, self-employed. These people violate Rich Dad's lesson number 1. They work for money. These are the people that pay the taxes. That's why you don't work for money. These people don't pay taxes. In your country, in my country, it's the same. How many people know the rich don't pay taxes here? Today, you will find out why and how they don't pay taxes. Donald Trump doesn't pay taxes. Why? Real estate. And these people are big business. So this would be like I own a clothing store in downtown Barcelona or Madrid. This is Zara. Different mindset. This is a person with a small restaurant. This is McDonald's. This is a small person with a coffee shop. This is Starbucks. So today, the reason you want financial education is without financial education, you can't come over here. Rich Dad would break out the Monopoly board game and we'd play Monopoly. So for months, we'd just play Monopoly, having a good time. And finally, I started to see it. I said, 4 greenhouses, 1 red hotel. And he said to me, someday, these greenhouses will be a big red hotel. So I was 9 years old. When I was 19, I came home from school in New York, and Rich Dad owned the big red hotel right on Waikiki Beach. He had gone from a poor man to a very rich man in Hawaii in 10 years. That hotel just sold last year. He paid $1.2 million for it. It was a lot of money back in 1968. He just sold it for $800 million, tax-free.
How many of you would like to learn how to have infinite returns? So it's really very simple. See, the banks, when you put your money into a bank, that becomes an expense of the bank. The bank owes you money on your money. So the banks are set up for us to borrow. Now, unfortunately, some people borrow credit cards. They buy cars and clothes and things like that, and you need those things. But really, what you should be doing is buying assets, using other people's money, your money, in the form of debt or mortgages to buy assets that cash flow. It's that simple.
See, debt is money. After 1971, when Nixon took the dollar off the gold standard, money became debt. And so the people who are losers are savers. So as Kenny says, you put your money in the bank as a saver, Kenny goes in and borrows it out as a debtor, and we use that money to buy millions of dollars worth of real estate. But most people say, well, I can't do that because I don't have any money. You don't have any money because lesson number 1 says, the rich don't work for money. So we learn to use debt to create assets. And assets keep putting money in our pocket. Every month, Kenny sends me big checks, and I give it back to him because he buys more property with it. I do not like stocks because stocks are manipulated. I do not invest in mutual funds or ETFs or those things. The fees are too high. I cannot use debt, and the taxes in most cases are against me. I took a 3-day real estate course. It was a very good real estate course about how to use no money to buy real estate. So I will show you the numbers really quickly. The property was a little condominium, 1 bedroom, 1 bath, $18,000 US. It was on the beach of Maui. The reason the price was so low is the market had crashed. Smart investors always wait for the crash. So this thing crashed. I had to look at 100 properties once I left the class, 3-day class. I had to look at 100 properties in 90 days and write a 1-page report on each of those properties. As my instructor said to me when I left that 3-day class, I was 26 years old, and the instructor says, your education begins when you leave the class, not now. So with this here, the instructor said, I had to buy the investment for zero money. Zero money. Most people will tell you, I can't invest because I don't have money. That's a loser. Always says, I can't afford it. I know some of you right now saying, well, I can't afford it. I don't have time. I have children. I have a job. I have bills to pay. And it is those excuses that keep you poor. If you do not change that talk in your head, you will always be the poor person. So there was about 32 in my class, 3 days long. I think only 3 people completed the exercise. We looked at 100 properties, wrote a 1-page report. At the end of the 90 days and 100 properties, this was the best property. So I went back to the person, and it was in bankruptcy. It was right on the beach, just as pretty as this beach here. And he said I had to have $2,000 down. This is called equity. Again, it's the language of money. So I have equity. The bank was going to lend me $6,000 in debt. Now I had the $2,000 in cash, but the name of the game or the exercise was, could I buy it for zero? So what I did was I paid for this property with a credit card. So now it was 100% debt. With that 100% debt, I made $25,000 a month. I was a free human being. I never needed money again. If you can make money with no money, that is called an infinite return, because I have no money in the deal. If I had put $2,000 in the deal and I made $25, my return would be approximately 12%. Easy. That's why I love real estate. But if I can buy it with debt, which is what Kenny does, then our returns are infinite. That is real financial intelligence. It is the way the rich get richer. We use debt.
So when you put your money into a pension, then I knock on the door of the pension, and the pension gives me this and this. That's how it works. Because they're trying to put your money to work. So that's why the deals are so important. Now this could also be a bank. I could go get the money from a bank. Because banks also will sometimes finance your equity in the form of debt. You know, it's just money. So you can call it whatever you want. But it could be 100% down payment in the form of debt. Another way is the insurance companies, like I mentioned. So when you put money into the life insurance policies, that money is expected to be there later. That's also invested here. It's also invested in the stock market. It's also invested in lots of different things. But pensions, insurance, money, deposits at banks, all of that is invested through people like me. So once you understand that it's your money being put to work, it doesn't really matter if it's in the form of debt or if it's in the form of equity. Because really, it's just the cost. What is the cost of the equity and what is the cost of debt? So right now in the US, I'm borrowing debt at about 4%. Here in Spain, I'm told it's a lot less. So if I can borrow at 1%, let's say here in Spain, and my inflation rate is 3 or 4%, then you're already making money. Because whatever you're buying is growing faster than the cost of your money. But when the market crashes, You should be looking at as many as you can and trying to buy as much as you can.
Your house is not an asset. So in today's world, if you want to be rich, you have to know the difference between assets versus liabilities. One of the reasons so many people are struggling financially today is simply because they're calling their liabilities assets, such as your house is not an asset, your car is not an asset, and things like that. So very simply, when I was a young boy, my rich dad taught me, he says, you have to understand a financial statement. So this is an income statement, this is a balance sheet. Now this is overly simplified. He says, what creates something to be an asset is very simply assets, cash flow money into your pocket. And a liability takes money from your pocket. So for most people, their houses are not assets or liabilities because every month it takes money to live in that house. Even those who say, well, I don't have any debt on my house, I've paid it off. Look, you still have insurance, you still have upkeep, you still have maintenance. The lazy people use their own money. And that's because I have spent much of my life raising capital. You know, today you have crowdfunding and all that stuff. But the reason I had to learn to raise money was because I had no money. And so if you read Rich Dad, Poor Dad, in there, my rich dad always said, never say, I can't afford it. He says, figure out how you can afford it. How can you do something? Figure out how you can do something. So over my lifetime, most of the projects I've started, I've never had any money. I like not having money because it forces me to think. I get creative. I have to educate myself. I have to talk to rich guys. Hey, how'd you do this? How'd you do that? How'd you do that? Over my lifetime, I've raised hundreds of millions of dollars. And it's because I didn't have money as a young person that I learned how to raise capital. And it's really quite simple. You have to find an asset that's worth more than me. You know, if they can't invest in me because that's called slavery, buy me, So what I do is, when I started off, I read about it in Fake. I started off looking for this one little piece of real estate. I found an excuse, this 1-bedroom, 1-bath condominium on the beach in Maui. And I found an excuse for people to give me the money. All I had to do is assure them I'd pay them back. So my first deal was an infinite return deal.
NOI means net operating income. So if you really think about it, it's just income minus expenses. That's all it is. And so it's important to know where you are financially. So a banker is going to look at your income after expenses. So that's a great way to say it.
Yeah, it's really quite simple. So let's say, I'll keep the numbers simple. You have $1,000 income and you have $500 in expenses. This is a property.
Yep. So you have a $500 NOI, or net operating income.
So why is that important?
Well, the banker looks at that number because that's the number that they see to be able to pay back any debt you might want. So they're going to look here and they're going to say, okay, this person has $500 in NOI, therefore we can give them a loan, say up to, $350, $250 or something like that. So they're not going to give you a loan for the whole amount because they don't want you to be that tight. So but what they're going to do is they're going to look at the NOI and say, how much can we loan you? A lot of people get hung up here because they don't have a financial statement or any way to go to a banker, let's say. But sometimes a banker will look at the property itself. So they'll say, like the one you explained, they'll say, this has a bad NOI on it, why would we give you money? You know what I mean? And then so that's when the financial education comes in and you say, well, this is what I plan to do with it.
Correct. What Kenny is saying, I'm keeping the numbers simple. He's had income of 0 and this is 1,000.
So you'd have a negative NOI.
And the banker goes, tell me why.
I can't lend on that, right?
Right.
Because it's a higher risk of being able to be paid back. The NOI, or the net operating income, determines the value. So you back into it with another vehicle called the capitalization rate, or a cap rate. So it's actually, well, we're getting a little technical, but typically the cap rate or capitalization rate divided into the NOI determines the price. So that's generally how that works. But in the case that we were talking about, the value of the building with no tenant in it is way low, and there's really no income. So it's basically whatever the structure is. So I've seen lots of situations where a vacant building, somebody might have spent $5-10 million on a building that's completely vacant. Vacant warehouses, vacant whatevers, right? Sometimes you see them get converted into clubs or whatever. There's value there. Somebody spent a lot of money on it. Well, one time, somebody owns it too. It could be a bank, it could be whatever. So taking that and creating value, sticking a restaurant in it, a gym in it, a club in it, it doesn't really matter who's in it. Well, it does, because you want them to pay you, but now you're creating the income, and then that's how you create value. So in that example, let's say you buy a building for $1 million, on a block. With a tenant in it, it could be worth $3, $4, $5 million.
So if it's a tenant in it, the value is up.
Yeah, right? Because what you do is you put all that together, and then you can actually sell it. There are ways to do it. So in that particular case, you might get a loan from somebody like Robert and say, hey, I need $1 million, and this is my plan. And then once you get a tenant in it, then you go back to the bank and you say, hey, give me a loan. And then they give you a loan and you pay Robert back. So I have a friend, for example, he actually bought a building in a town up in Idaho where I have a vacation house for about $1 million. And it was an old Elks building, a beautiful building downtown, but it had been vacant for a long time. He bought it, and he put like 30 offices in there, small offices, 1,500 to 2,000 feet each, and grew the revenue, right? So everybody pays. So he broke it up and his expenses, but now he's got 30 people paying rent, as opposed to just, one big vacant building. He turned it into a pretty cool workspace, for everybody.
His job is to get this up, keep this stable. Then he goes back to the banker and says, look, we've got all these tenants, money's going up. So we now want $12,000.
Yeah.
Because he's improved income, kept expenses low, building's more valuable.
Yeah, the key there is the bank's always looking at your NOI to pay back their loan. So the more you can grow that, the more loan you can get. Mm-hmm. I think it's really super simple. Wow, real estate is very slow and very dumb.
Every month we get cash flow.
Yeah, I like that. I like, we're not banking on something going up. This is called creating value. We're not parking our money in something and hoping it goes up. This is very strategic.
This is financial education. This is smart. This is having your banker be your partner.
Yeah, and these are long-term assets. This is a business. This is like managing a business. We would not sell these. So unlike the stock market or something, we're not trying to time things. We're trying to generate cash flow here and then move to the next one. And it's tax-free.
It's tax-free.
The reason it's tax-free is because when we use debt to pay back debt, it's debt, so it's owed. So when Robert gets his money back, it's actually tax-free.
I lend him $1 million. He fixes all this. The bank gives him $3 million. I get my $1 million back,
right?
And that is tax-free. I get it back, and I still own the building with Kenny.
You gotta wonder why, if you can invest $1 million and get it back tax-free and still have lots of cash flow,
and still have the cash flowing this way,
why somebody would think that. It's a pretty simple model.